Hello, good morning, and welcome to Saxo's weekly market outlook call. I'm Charu, I'm a market strategist with Saxo Singapore, and with me are my colleagues Jessica, Amir, and Redmond Wong. Let's dig in. And it's been a rough week in the stock markets with, of course, the Federal Reserve first renewing its commitment to do whatever it takes to bring down inflation, even if that means pain in the economy or higher unemployment rates. We saw the S&P 500 fall close to 5%, ending the week below 3,700. The index is now down 23% from its January 3 closing and is just a notch above its June lows. But the Fed wasn't the only shock to the global markets last week. We had an intervention from the Japanese authorities as well as they stepped in to defend the yen for the first time in 2 decades. And at the end of the week, we had a bigger than expected tax cut in the UK that has significantly increased the debt and inflation risks for the UK economy. And it saw a major sell off in the bond market as well as fresh lows in the sterling. We're seeing big moves there this morning as well. So let's look at these one by one. First, of course, the key thing was the Fed decision. For those who could not attend our FOMC webinar that we hosted on Thursday after the decision, the recording for that is available on our platform and the YouTube channels as well. But two key things, if I would summarize that. One, interest rates will continue to go higher, even if that means some economic pain, rise in unemployment rate. And the second key thing was interest rates will remain high after they reach a peak. To kind of ensure that inflation is firmly in control. Fed Chairman Powell kind of hinted that he does not want to repeat what happened in the 1970s, where interest rates were eased prematurely, and that saw inflation picking up again. So he wants to hold on to the rates at its highs to make sure that inflation is firmly in control. Now, markets have priced in a lot of the Fed's hawkishness, but there is room for some more upward pricing there. That means equities will see more pain and dollar will still remain the king. We do have a slew of Fed speakers on the wires this week. They would likely reaffirm the hawkishness that we saw last week. And let's ask Jessica here. Jessica, could this stock sell-off get much worse from here? How do you see the market players reacting to that, and what are the key technical levels to watch?
I think the first thing that we might mention is the swifter reaction on Friday. So we saw because of I guess potentially peaking hawkishness, we saw the proxy for global growth, oil, be considerably sold down. So the oil price measured by crude oil rose about 5%. And it's important to note why this is occurring and why we could potentially see some triggers in oil equities move lower and drag the S&P 500 down further, is that when there's a higher oil price, that actually makes it really hard to physically trade. But the oil price is being crippled lower now by the US dollar moving higher. So the US dollar hit its highest level in about 2 decades on fears that you just mentioned of rising interest rates continuing to get worse, and that could potentially tip some economies into recession. So the technicals for oil stocks are looking quite bearish. We've been speaking a lot about Oxy. Occidental Petroleum, a very hotly traded stock at Saxo and indeed by Warren Buffett, but that one is particularly looking bearish, and the weekly chart and monthly chart are suggesting further downside is ahead. But going back to your overarching question, the S&P 500 is looking quite bearish. If you look at the monthly chart, it's quite really supportive of those that are shorting the market and also putting put options on downside for the S&P 500 and also for the NASDAQ. And just lastly, it's really worthwhile noting that across the industry, we are seeing an extraordinary amount of investors pile into markets, buying put options against further falls. So over the last 2 weeks, about $10 billion was spent on people buying options to protect against downside. So that's something to consider. The technicals are looking bearish, and there's further evidence of people mounting in.
Right. And on FX, like I said, dollar obviously still remains the king. It is the key catalyst for markets now. In fact, more than the Fed pivot, I think it's more important for the dollar to pivot really through even think about a turn in the equity markets. But for now, it remains supported by higher US yields. Friday, we had US PMIs coming in much better than the Eurozone or the UK PMI. So the relative sense obviously still, supporting the fact that the US economy is still much more resilient than elsewhere and continues to, that continues to provide ammunition to the Fed to be more hawkish than some of the other central banks as well. But also, the second key thing was the safe haven flows, which we can touch upon later. But let's ask Redmond first about what's happening in the treasury markets and how that can filter through to the US dollar or to the equities in general.
Yeah, I think the treasury market is in the process of adjusting to what Charles you just described. Seems that the Fed has become increasing actually very hawkish, and this all started from Jackson Hole, and then last week we have in the FOMC both in the economic projection, which showing very high rate going for longer, and also in the press conference, and he indicated the Fed is willing to accept some pain in the economy. So I mean 2-year yield in particular were hit, now trading at 4.26, and we think that is probably that has more to go on the upside in yield, and short end of the US Treasury curve will continue to sell off, and the 10 years now trading at 3.74. And it's likely that it might go to 4%. But having said that, the longer ends will be more anchored because of the inflation expectation under a more it's a hawkish Fed, so it's putting some more confidence in the long-term inflation outlook, and so the probably will be the curve will continue to be even more inverted, and especially I think as the economy going more and more towards a severe slowdown or even recession, and there's a chance that the 3-month, 2-year curve will eventually become inverted as well, i.e. money market yield will be higher than 10-year treasury bond yield. And so I think it's so in the longer end, over the next 1 month, 2 months, and probably it's the time to tiptoe to find can pick up some yield, and in the short end, the headwind is stronger.
Maybe I might just ask what that means to new investors who are just starting out in trading. Redmond.
Yeah, sorry?
What does that mean to new investors?
Yeah, I mean, it's
in basic terms, just for those that are listening that might not be as sophisticated.
I mean, it's for investors. I think, as I mentioned earlier, it's time to in the fourth quarter, probably it's time to start picking up some yield and expecting some asset reallocation from stock back to bond. And I know bond has not been performing since the beginning of these years, and both stock and the correlation actually, from negative become positive. So i.e. bond prices and equity price came up and down together. But going forward, I think when the Fed has convinced the market, they become more hawkish, and the yield level is much higher and provide a lot more margin of safety. And it's time to pick up some bond going forward, even for new investors, and can go stick with the high graded and bond, and not to take any credit risk for the time being, because it's the financial condition is going to tighten. And when financial condition when the Fed tighten financial condition, that will hurt, that will actually widen credit spread, that i.e. will hurt the lower yield of lower weighted bond than the high grade bond.
Nice. I think that's really a great idea to consider, perhaps, as we continue to see more and more pressures on the equities. But the downsides that we've seen in the 60-40 portfolios so far this year actually may have some lows coming up, and then we could possibly see a turn there, as bonds do provide the kind of divergence that they used to previously, if you're exposed to the right categories. But the second key thing, I think, think supporting the dollar this last week and probably into this week as well would be the safe haven flows. We have seen some further development in the Russia-Ukraine front with referendums in 4 states, which are about 15% of Ukraine's territory. These are scheduled to end tomorrow, and what that means is that any fighting in these regions could be considered as attacks on Russian territory going forward, and that could give some leeway to Russia to have potential escalation there, or also actually go on to using some mass destruction weapons such as nuclear. That's what they've threatened. Now, what this could also mean is we could see further US sanctions on Russia. I don't know what's left to sanction there really, but we could see some secondary sanctions on oil, with the options being rather limited now, and that could see a further deterioration of the inflation picture globally. So some more, I think, risk off coming to the markets this week from the geopolitical front as well. Keep that on your radar. And of course, Jessica's already mentioned that the oil situation is getting a little bit bearish if you consider the demand side. But again, let's ask Jessica about what could the Russia situation perhaps mean for the oil market.
Well, I think long-term upside is there if we think about the big picture. So demand is likely to fall away for the downside now on the back of a potential, the R word getting louder, because interest rates are continuing to rise, because underlying inflation is continuing. So I think one thing that is really interesting though is that I think that we are seeing a lot of technical trading as well at the moment. So that is really worthwhile to point out. So there's a lot of paper trading going on that is pulling the oil price and gas markets down, but they do remain supported once demand resumes. But nevertheless, we are seeing other prices in energy pick up. So I hate to say it, but the coal price is higher, was higher overnight and is higher today, just on the back of potential further sanctions. So that's something to consider.
Yeah, absolutely. And of course, still important to consider the crops that come out of the Ukraine zone, wheat particularly, but also I think diesel remains important to watch, as we could potentially see some, geopolitical concerns rise this week. I think the other key thing to watch has been the sterling, which is kind of approaching parity again against the US dollar. We've seen a big drop from about 1.08 to 1.04 this morning. Now that does mean that there, with the fiscal expansion in place, from the announcements that came out on Friday, we could potentially see an emergency rate hike by the BOE to preserve its credibility, to preserve the value of the sterling. Government's tax cuts have been so massive that will only fuel further inflation, further debt concerns. So the stagflationary picture is getting worse for the UK, and I think it will be important for the BOE to step in at this time to kind of reverse or at least stall this trend for now. The Chinese yuan also remains on watch. I think we do have the China PMIs due this week. And Redmond, what are you watching in that?
The China PMI probably will be a little change in this September, and the official NBS manufacturing PMI, now the consensus is calling for 49.6, and that will be a little bit of improvement from last month, and then is the Caixin and manufacturing PMI, which is way more on the coastal area, and that is expected to slightly slow down to 49.4, and from last month 49.5, and both just still marginally below the threshold 50. And so still are in this kind of contractionary territory. And I think one thing, I mean, that the lockdown earlier of this month, including the last city like Chengdu, and also so the weak, rather weak data we saw from the those port throughput in container shipping, and those indicating is a slower export-related manufacturing activities, and those will be putting some pressure on the downside on the PMI. But at the same time, some of those data from steel output and so steel production and demand and so on has improved, and so that will be that might be a chance for a supply onto the upside, but it's very difficult to call, of course, for this 1 month data.
The Japanese yen also, I think, very important to watch. The line in the sand here appears to be at 145, and we are getting close to 144 again. So more than half of the decline that we saw last week in USD yen has been erased, which does put the focus back on Japanese authorities stepping in. We have Governor Kuroda speaking today, and I think more steps remain likely, because the US Treasury has also kind of said that it understands Tokyo moves, not really, endorsing it, but not really, obviously, criticizing it as well. So despite it remaining some kind of a unilateral intervention, as it appears, the effect will still probably remain limited, but I think we can expect some more measures there today after Japan returns from Friday's holiday. What about Australia, Jess? What are you watching there this week?
Well, the Aussie share market, I guess, has been a proxy of the Australian economy being quite strong amid the global slowdown. So if we think about the Aussie economy, it's been powering up, and we had services sector PMI data out last week that showed that the Aussie economy is gaining momentum and strengthening. So that's all good. However, this week we're likely to get some clues that the Aussie economy is losing its strength. So this week we get retail data out, and we also do get credit data, i.e. borrowing. And both of these key measures are likely to show that conditions are weakening. So last month we had retail trade hitting an absolute record all-time high because the people were going out and they were spending a record amount at retail outlets, or retail shopping centres, I should say, and also department stores. Perhaps they were buying winter clothes and rugs, etc. But that spending is expected to fall this month. All in all, the Aussie share market will be reflected on, and we are expecting further downside for the XJO. It has been quite resilient. It only fell 2.4% last week, whereas the S&P 500 fell over 5%. So expecting some weakness to come in here. So there's plenty to watch. Also on the currency side of things, the AUD USD is seeing further weakness and hit a new low today. But it is catching some bids as people get their ducks in a line. It's also True and Redmond, and for those listening, worthwhile noting the GBP AUD. Or sorry, rather the AUD, Great British Pound, is a currency to watch, and with the UK deficit to increase and the Australian surplus to rise, this is a currency pair that's probably likely to gain further momentum. So, yeah, that's it from me. Hand it back to you, True.
Great, yeah, and we are at the end of the Q2 earnings season, and Q3 earnings season actually starts in 3 weeks, with the US economy's leading indicators suggesting that we could see some ugly numbers there, especially in terms of the margins. I think the only key report to watch this week would be probably Nike on Thursday. Let's ask Redmond if he thinks if Nike could deal with the kind of inflation blow that other companies are seeing as well. Redmond, you're muted.
Hi, our head of equity strategy, Peter Garnier. I think he put up a very good articles on Friday, and he mentioned also about Lucky. Yes, I mean, yes. No, I think. Hi, yeah. And yeah, and on the I think Peter, our head of equity strategies last week, and put up a article on Nike, and yeah, he addressed exactly the question you just asked, and mainly is I mean the analysts survey by Bloomberg, and overall are expecting some rebounds in the operating margin for Nike, and revenue pretty much is revenue wise is pretty much low growth, but is more expecting it to have some kind of rebound operating margin, but that may be it's subject to very severe test by the market by the situation, because it's with the strong strength in US dollar, and also the weak demand actually reported by many other retailers, and for global demand, and in Europe and also in Asia. So that I think that there's a potential for disappointment for these rebounds in operating margin, and Nike probably will also subject, cannot be immune from this kind of margin pressure of high input costs, and also very strong dollar when they translate their overseas earnings into US dollar terms.
The dollar
I
is going
think
to be a key story, I think, in the Q3 earnings season as well. Yeah, go ahead, Jessica.
Sorry, I just think it's thank you. I think it's really worthwhile pointing out how to potentially trade this. So typically, sorry, I know we're going over time, but it's I think it'd be remiss if we didn't point this out. We know around earnings season time, a company's shares move if they beat or missed expectations. And so based on what Redmond's just highlighted, if we do see a disappointment, and if they do miss that margin growth, or if they do guide for a weaker than expected outlook, then you could potentially see their shares fall away. So then that brings in the technical aspect. What do the technical indicators suggest? And we just ran this morning. So the technicals are quite bearish. The monthly chart for Nike is showing further downside is ahead, also on the week chart as well. So the next level of support is $87.03. That's $87.03, and Nike closed at $97.02. So if there is a bit of a disappointment, they would potentially, they could test that low. So that's something to keep in mind. Back to you, Charu.
I think that just brings us to the end of the discussion today. No central banks this week, but certainly a lot to watch as discussed in this call. And thank you for tuning in. Have a good day, good week, everyone.
And for any questions, feedback, or comments, please reach out to your Saxo point of contact. And yeah, take care.
Thank you.